Intercompany transfer of services and assets. We're going to conclude our downstream sale of equipment example, and we're going to combine the equity method of accounting and consolidation accounting, and that's going to take place in year X10, and we'll conclude it with a sale in X11. In X10, the current year activity or the equity method entries would look like the following. It doesn't necessarily matter that we've got the net income or the dividends, but the point here is that we're going to continue to make the entry for the excess depreciation until the asset is sold. So for the next couple of years, we'll debit investment, credit income from subsidiary for the excess amount. That leads us to the consolidation accounting at the end of the year 10. And we're going to just look at the recap of the entries through X10 and notice a couple of things that are happening here. One is we're going to have to make several entries over and over again, and I've listed them out individually so you can see. The first is we reestablish the equipment to 225 in the accumulated depreciation, and the other entries relate to the depreciation expense that we took in the various years. So we see X7, X8, and X9, and this kind of ties into the previous learning objective when we said that we continue to make these until it's sold. We see the last EJE is that this is to record the excess depreciation for year 10, and we can indicate that it is a current year number because we see depreciation expense there. Well, the equipment is sold on January the 1st, 2011, or X11. A couple things to point out here is the equipment is sold on January the 1st. So that means that the subsidiary will not depreciate that at all for X11. So there won't be any excess depreciation for X11 since there's none there. It's sold. And the subsidiary will have a gain or a loss on this transaction. And remember that the subsidiary depreciates the asset at their cost, and they depreciated it for 4 years, 7, 8, 9, and 10. And that gives them a net book value of $81,428. So what that says is that the sub has a gain of $78,572 on the sale. And that $78,572 will be reflected in the subsidiary's net income number, which the parent will share in. What we're concerned with, though, is any unrealized or deferred gain that can now be recognized since the asset has been sold to a third party. If you remember back to the first learning objective, the asset was sold at a gain of $32,500, and that gain could not be recognized because it was sold to a related party. So we had to postpone that gain until it's sold, and it's finally sold in X11. But what we've been doing along the way is we have been recognizing a small portion of that gain each year. And that small portion has been the excess depreciation amount, $46.43. So if we take the original gain of $32,500 and subtract from it the gain that we've recognized already, $18,572, that leaves us $13,928 in gain that we can recognize immediately since the asset has been sold to third parties. And since we know that this sale has taken place, we can recognize this gain under the equity method of accounting during the year. So during the year, when we record this, we will debit investment subsidiary, credit income from sub, for the gain that is to be recognized, the $13,928. And this would be in conjunction with any net income and dividend entries we will record as well. That leads us to the last thing, and that is the consolidation accounting. We're going to focus on any special allocation items that we've got. And the first thing we have is to address any equity method entries we make during the year. And this is the entry we just made for the equity method. Debit investment, credit income from sub. So to eliminate that, we're going to debit income from sub, credit the investment. Now, the previous EJE eliminated that number that was in the income sub account. So what happens is we've got $13,928 of a gain that we can recognize. So we're going to recognize it, and we're going to do it not in a direct way, but an indirect way. And to do that, let's look at a recap of the EJEs relating to the equipment through X11. And this is the entries that we've made relating to the equipment sale for each of the years. You can see here we've got the entry to reestablish the equipment. And we have the excess depreciation that we've taken for X7, 8, 9, and 10. And as we said earlier, since the transaction was on January 1st, there is no depreciation expense for the 2011. If we were to kind of shrink these down and combine them into one entry and took all the like descriptions and put them together, this is what we would get. We would get investment sub, which represents the gain, and the amortized excess depreciation, $13,928. Equipment and accumulated depreciation of the following. Now, what we've seen in prior entries is that the investment sub-account is there, but when we dispose of some asset, say the inventory or the land, when that asset was disposed of, we eliminated that asset account and brought it to some income account. And we know that the equipment and the accumulated depreciation are no longer there. So they're gone. They've been sold. And if we net those two numbers together, the accumulated depreciation of $48,928 and the equipment of $35,000, we know that debits must equal credits, that the net number is $13,928. And we know the depreciation, accumulated depreciation of equipment no longer there. If we were to reclassify this, this would do a couple of things. One, the investment entry was no change, but what it does is it takes that deferred gain that was there and recognizes it in the current year. So if we were to recap everything, we could kind of consolidate a bunch of things together. And this is what the two entries that we need to make would look like. Income from sub, investment, $13,928, and then we recognize the gain. Now, I'm going to back up a little bit and just point out something to you. If you want to list them out, the EJEs individually like this, I'm more than happy with you doing that. It does not matter to me if you list them out individually like this or you consolidate them like this. As long as I can see what you're doing, I'm fine with that, because this does take a little time. You can abbreviate if you like, but it doesn't matter to me if you list them out individually or you combine them. I think listing them out individually gives you you can see where information comes from, so it's a little clearer for you, but I'm okay with either one. In our consolidated net income, we would recognize the deferred gain of $13,928 and pick it up as income this year.